Up YouTube, this is the Working Investor. Today I want to show you how I analyze positions and which ones I look into for me that has a better risk-adjusted return. Let's open up the options tab for Microsoft, for example, and let's go to June 7th, which is about 24 days to expiration from tomorrow. And for example, let's go down to the 0.3 delta, which is the $405 put. You can see on the top here that Microsoft is trading currently after market close at 414.05 a share. So this is 0.3 delta. It's a little rich for a delta for me, but so let's say it's $430, right? And you're putting up $405 for the premium. So for example, let's say you're going to receive $430. You're going to divide that by 40500. So you're going to put up $40,500, and then you're going to times it by 365 days in the year divided by 24 days. So in the trade, and then you times that by 100%. So this is a risk-adjusted return. This is a 0.3 delta, and a 0.3 delta supposedly has a 30% chance of a loss and a 70% chance of a win. And your annualized return for this is a little over 16%. And let's go down to a further expiration. Let's go down to June 14. And let's go to the same strike price of 405, which is a 0.32 delta. So you could see the delta is a little higher, but you are getting more money. So you could think, oh, it's equal, but maybe it's not, because look at this. Let's say you're going to get $528. So let's go to $528 divided by 40500. So it's $40,500 in collateral to put up to receive $528. And then you times that by 365 days of the year, and then divided by, so that's going to be 31 days because it's 7 more days in the trade. It's 1 week further, so divided by 31. And you see here, times 100%, this is a 15.35% annualized return. So even though the delta for the 405 put is higher and you're giving yourself more time in the trade, it may not necessarily be a better annualized return necessarily, because you have more risk and you're getting less. So you have more risk of 7 more days in the trade, and you have more risk because the expected move is a little bit, it's 2% more chance that you would lose, supposedly. So that's why in this situation, I would personally I favor the 405 put, even though the premium is a little bit less. But if you look at annualized return, risk-adjusted return, for me, that is better. Am I going to do this trade tomorrow? I don't think I would. And am I telling you to do this trade? I'm not. I'm not a financial advisor, but this is just what I do. One of the exercises that I do when I try to annualize and compare apples with apple trades. Working Investor over now.